Hello traders, Gary Wagner here, 12:23 in Honolulu, 6:23 in New York on Thursday, 18th day of August, 2022, and this is the Daily Report for gold and silver. Now for the fourth consecutive day, gold has lost value today. Gold futures basis the most active December contract gave up $4.50 or 0.25% and is currently fixed at $1,772.20. A lot of that, but not all, has to do with recent dollar strength. The dollar itself had a strong gain today of 0.9%. It's currently well over 107 at 107.43 after factoring in today's point change of 0.944. You can see that on this daily chart, and the weekly chart over here really indicates the strength of the dollar this week. Lastly, silver is still trading under pressure also. The percentage drawdown is less, but it's also had 4 consecutive days of price decline. Today, it gave up 1.37%, and after factoring in the loss of 27 cents, the September contract of silver futures is currently fixed at $19.46. Traders, the first chart that we are looking at is a daily chart of the continuous contract of gold futures, this in bar format, so we can focus on price change and the Fibonacci retracement data set that I've just put up. I've created this data set from the absolute low that gold traded to. This, of course, is back in June, about the 20th or 19th day of June, up until it hit this top at 1825, and that occurred the first or second week in August. The other thing that we want to focus upon is the gap in price. It doesn't appear on a December futures chart, but it does appear on a continuous contract chart, and this gap or price void is when they changed from the August contract month being the most active to December and the spread between them. We have retraced at this point a total of 38.2%. That comes in at $1,769. Below that is the 50% retracement at $1,751.80 and the 61.8% fib retracement at $1,734. My assumption is that gold will fall anywhere between 38.2 and 50% in terms of the price gains witnessed as gold moved from 1,678 up to 1,825. So we are in the area where we are looking to initiate a long position. We want to be able to be covered in case we have not only the gap filled, but we get some tails, meaning some intra-cycle lows that go into that. So we're looking at having a stop at around 45. So for this trade to make sense, we really want to get in at about 55 or so. Right now, we are remaining flat with no active trades, looking to position ourselves. And I just wanted to make you aware of the criteria we're looking at. Our entry point is between the gap, and at that point, we will begin to plot where we believe a strong exit strategy is. Now, in terms of the marketplace itself, realize moving averages are always going to be a lagging indicator. The longer the cycle, the more they lag. The shorter the cycle, the more sensitive they are, which is why you see the 50-day moving average moving so far from the 100-day, and the 100-day just crossed below the 200-day, which puts this in a full bearish alignment. 50, 100, then 200. For a full bullish alignment, you always have it reversed, or the short-term moving average on top, the 100-day below that, and the 200-day below that. However, they lag, and because of that, it doesn't give us pertinent information in terms of current real-time data. It compares price points to where it is at now to relative areas of support and resistance and market price action. Based on that, I feel that we want to continue to wait and see if gold wants to trade within this gap period. I would look for the gap to actually get filled, which means that I believe we could enter this as low as $1,755. We'll focus on that tomorrow. We will be sending out a trade alert before the weekend, and that will go out via SMS text message as well as email. So look for that in your text as well as your emails over the next couple of days. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.